Hello, welcome to the weekly technical analysis review here at XM.com. I'm Rafi Currency Analyst, and today's Monday, January the 8th, 2018. Today we're going to be looking at the dollar yen, the euro dollar, the pound dollar, and the Kiwi dollar pairs. Let's start first with dollar yen. We can see the near-term bias is fairly neutral at the moment. Although risk is to the upside, we can see the stochastics are trending upwards and the percentage K and D lines are positively aligned. There is resistance, however, at around the 113.30 area, and that of course has been a heavily congested area in the past as well. Prices would need to rise above the 113.65 area. We can see previous attempts to climb up above that level have failed. We saw that twice in December. So we've got those tops of 113.74 and 13.63. So a break above that level is needed to strengthen any upside momentum, and then that would open the way towards the 8 months high of 114.73 we saw back in November. To the downside, we are seeing immediate support coming from the 113 handle. Not too far below that, we have another support area around 112.80. A drop below that region would take the dollar yen pair into the Ichimoku cloud, as turning the near-term bias to neutral to a bearish one, and then that could also possibly open the way towards the 112 key support area. A breach of the 112 handle, we could then see prices targeting another recent support area around 111.65. That's that support in the past, and it's also where the 200-day moving average is currently flatlining. And then we have that 2.5 months low 110.83 from also back in November. So a drop towards that level, even below that, that would definitely shift the medium-term outlook, which is currently neutral. It would shift it back to bullish. On the other hand, a successful target of 114.73 would shift the medium-term outlook to a bullish one. Moving now to euro-dollar pair, we can see the pair is looking fairly bullish at the moment. In the short term, though, risk is to the downside. RSI had been climbing steadily, breaking into overbought territory, and that explains the current dip downwards. We can see RSI is falling, though comfortably above 50. We are seeing immediate support coming at around 1.1980. That's in fact the 50 moving average in the 4-hour chart, and not too far below that we have 1.1960. That's the top from back in November. A drop below 1.1960, we could then see euro dollar targeting the 1.19 handle, and then we could, and if we see further declines, that could open the way towards 1.18, and then a drop below 1.18 would shift the near-term bias back to a bearish one, as that would take it below the 50-day moving average. To the upside, though, the next target should come at the 161.8% Fibonacci retracement of the downleg from 1.1960 to 1.1770. So the 161.8% Fibonacci is around 1.2110, and then the next target up would come from the 261.8% Fibonacci at 1.2355. Looking at the medium-term picture, we can see the bullish structure has strengthened following the recent uptrend, and although prices have been consolidating since early September, it's still looking fairly bullish, as prices comfortably above the 50-day moving average. Moving next to pound dollar. Pound dollar, like the euro dollar, is fairly bullish at the moment, though near-term risk is fairly neutral at the moment. RSI is flat, around 61, still comfortably above 50. Immediate support is coming from the 78.6% Fibonacci of the downleg from 1.3656 to 1.3026. That's around 1.3520. A breach of that level would take prices to the 61.8% Fibonacci at 1.3415, and then below that at the 50% retracement we've got 1.3340. That's just above the 50-day moving average, so clearly a major support area there. A drop below that would shift the bias back to a bearish one. But if we were to see further gains, we do have immediate resistance from that high we saw back in September, 1.3656. That was a 15-month high, and then above that we have the 1.37 level. A break above that would signal resumption of the longer-term uptrend for the pair. In the medium term, though, despite the recent consolidation, we can see the 50-day moving average has continued to trend upwards. So the bullish structure is still intact, but clearly without a break above the 1.3656 top, the bullish structure would risk turning neutral. Moving next, our final pair of the day is the Kiwi dollar. Kiwi dollar had been on a longer-term downtrend. We can see that big decline from July until November of last year. But we are seeing signs of a possible reversal upwards. Prices have climbed back above both the 50 and 200-day moving average. So medium-term outlook, we can see the MACD has, after being strongly bearish, has turned significantly, has climbed to significant positive territory and is above its red signal line. So it is looking bullish both in the short and medium term. But in the short-term picture, we can see RSI is in overbought territory above 70, so there is a risk of a downside reversal in the medium term. Prices have already met resistance at 61.8% Fibonacci retracement of the downleg from 0.7434 to 0.6780, so a clear resistance area at around 0.7185. If you do see a downside reversal, we could see support coming from the 0.71 handle. That's the 50% Fibonacci, and is also where the 200-day moving average is currently converging. And then a break below the 0.71 handle could open the way towards 0.6935, the 23.6% Fibonacci, which is where the 50-day moving average is currently climbing towards. But should we see a further upside, the next target would be the 0.73 handle. Just below the 0.73 handle is the 78.6% Fibonacci, and then we have that top of 0.7434 from back in September. So a break above that level would be a strong indication that the downtrend for Kiwi dollar has ended and is now entering a new uptrend. That's it from me. Thank you very much for watching and have a great day.